Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, November 14th. The US inflation data, in line with expectations, boosted the bets of another 25 basis point cut from the Fed in the December meeting, but hardly convinced the US dollar bears that it was time to sell. So up goes the US dollar and down go the others. More data is due today. So the US inflation release yesterday came parallel to market expectations, confirming that headline inflation in the US stagnated near the 0.3% level on a monthly basis for the third consecutive month. The yearly figure rebounded from 2.4 to 2.6% as expected, while core inflation remained stuck near the 3.3% level. Now, the difference between the headline and the core inflation numbers comes from weak oil prices. That's pretty much it, which helped tame the index that includes the volatile food and energy prices. But housing, used cars, airfares, and medical care continue to push the core figure higher. And the core CPI hasn't eased since July. Did you know that? And it has averaged near the 3.5% level this year, according to Bloomberg. So in summary, yesterday's CPI data looked, okay, but it could have been better. So the market reaction to the data was mixed. The US 2-year yield eased after hitting a fresh high since last summer. The probability of a 25 basis point cut from the Fed in the December meeting jumped back to 80% from near 60% before yesterday's CPI data. And Minneapolis Fed President Neil Kashkari hinted that he actually liked yesterday's inflation data, that it's on path to their 2% policy target. But on the long end of the US yield curve, the US 10-year yield continued to push higher and is preparing to reach the 4.5% level as next stop amid the rising bets that the yield deserves to hit the 5% mark on prospects of higher inflation under Donald Trump's pro-growth policies, the upcoming tariffs, and the Federal Reserve's potential ignorance of the upcoming inflationary pressures due to all that. So the US 30-year yield is now standing near the 4.65% level. As such, the US dollar that actually looks slightly softer after yesterday's CPI data release just rebounded to extend its rally to fresh highs. The US dollar index has now hit the highest levels in a year. It is clearly in the overbought market territory, with the RSI index screaming that the US dollar index has been probably bought too fast and in a too short period of time, and that a minor correction could be healthy at the current levels. Yet the picture is quite clear. The US dollar outlook is comfortably positive, and the US dollar bulls will probably be tempted to buy on rising suspicion regarding the Federal Reserve's ability to keep cutting its interest rates. Because not that the bets for next year Federal Reserve cuts have held since last month. So we are still in a dovish territory, but we are getting less dovish than a month ago. As such, the euro-dollar tanked to 105.34 level this morning, with the bears eyeing the 105 mark as next stop. The RSI indicator here, that's warning of oversold conditions in parallel to the overbought market conditions of the US dollar index, seems to be, pretty much the only challenge for the euro bears right now. Across the channel, cable is to 1.2673 level. The pair is this close to oversold conditions as well. Then the Aussie dollar pulled out the 65 cent support and is weakening below this level this morning, supported by the latest data that show that inflation there in Australia fell to a 3-year low, and the dollar yen spiked past the 156 level this morning, and it's near overbought conditions as well, but with some additional margin left before the Japanese authorities will decide to intervene directly into the market to ease the selling pressure in the Japanese yen near the 160 levels probably. Then the dollar franc rallied past its 200-day moving average, and the dollar CAD has pulled out the 1.40 target and is consolidating gains above this psychological mark right now. Now, I believe that the temptation to long the US dollar at the current overbought levels should, gently start fading in the short run and eventually bring in some tactical shows to ride on potential minor correction. But the medium-term outlook for the US dollar remains comfortably bullish. In plain English, that basically means that the price pullbacks that we might see in the US dollar, could be interesting opportunities to strengthen the bullish US dollar positions. That's pretty much it for the FX markets. Now, the US will reveal its latest PPI update today, and the new figures on that end are expected to point at an uptick in factory gate prices in the US in October. In numbers, the headline PPI is seen rebounding from 1.8 to 2.3% in October, and core PPI from 2.8 to 3%. And don't forget that there are components in these figures that feed into the Federal Reserve's PCE index that helps them to decide what to do next. Therefore, even if these numbers are in line with the market expectations, they should still be warning that a 25 base point cut from the Fed in December is probably not the right thing to do. Now, I'm not saying that the Fed won't do it. I am just saying that it is probably not the right thing to do. So Fed Chair Jerome Powell will be speaking today. Let's see what he has to say. If he dares saying something or anything at all in the face of the US politics are turning into a massive global TV reality show right now. I mean, I guess everyone pretty much saw that Elon Musk has been appointed to lead the new Department of Government Efficiency, which reads as Doge, guys. Yes, it reads as Doge, like Dogecoin, which is a joke currency that Elon Musk loves and used to pump, remember, in the past. So now Elon Musk is, in the government, and he is going to lead a department called Doge. So yes, obviously Dogecoin is going to the moon these days, and it makes Bitcoin look totally serious. Jeez, it is so much fun, and we're just starting. Elsewhere, there wasn't much for indices yesterday. The S&P 500 consolidated its gains near all-time high levels. Nasdaq 100 was slightly down yesterday, while the Dow Jones Industrial Index was slightly higher. The Russell 2000 stocks, on the other hand, didn't like the upside pressure that we see in the US yields, probably because the index fell nearly 1% at yesterday's trading session. Then European stocks failed to cheer the weaker euro, as Donald Trump is much less supportive of the value on this side of the Atlantic Ocean due to the tariff threat that he is at home, obviously. So the only positive in Trump's threats here is its potential to push the European Central Bank to cut the interest rates roughly to give support to the already weakened European economies. But alas, to be able to do so, to be able to cut the interest rates, the ECB needs to make sure that inflation has stabilized. Yet the rapid depreciation of the euro these days puts that objective in jeopardy. In the energy markets, while crude oil made a short attempt to the upside at yesterday's trading session on a surprise decline that we saw in US oil inventories last week, according to the latest API data, but gains remain limited. Now, the numerous failures to clear the $72.85 per barrel Fibonacci resistance keeps this market in the hands of the bears, with the ambition to push the price of a barrel to $65 per barrel bearish target. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow for probably another crazy trading session. But until then, good day trading, and don't forget to have fun, really.